Okay, class, I want to go over the solution to the quiz. I'm not going to be in class today, so I wanted to give you the solution to the quiz. And if you need to retake it, what I'm going to do is probably just change a few of the numbers on there for the retake before the end of the week, if you guys could retake this. But I'm going to go through the solution so you guys can see what you did wrong or you didn't do wrong. All right, so let's start with journalizing the transactions. The first part of this, of the accounting cycle, is to analyze the transaction and then journalize the transaction, and then we post it second. So let's take a look at issued $2,000 of capital stock for cash. So again, for the date, I'm just going to write the letter A there. But if there was a date there, then I would just list the dates. Let's say it's May 1st or May 2nd. I would just put May 2nd in there. But for the purposes of this assignment, we can just put the letter A there. So issued capital, $20,000 of capital stock. So I'm going to get the cash. Anytime I issue stock, I'm going to get cash. That's why I'm doing it. And then, well, I shouldn't say that. In some cases, you might get different version of stock. You might get preferred stock or common stock. You might actually issue stock for stock in some cases. But we'll leave that for later. So issue $20,000 of capital stock for cash, and then the equity account that I'm raising here is capital stock. All right, so that's for $20,000. Debit cash, credit capital stock because it's my equity. Purchase $250 of office supplies on account. So I'm just going to make that B, and I'm going to make this office supplies. All right. Actually, they just have it as supplies. Sorry. So I'll just leave it as supplies there. And we did it on accounts, so we're going to use accounts payable. Again, this is how business is usually done. Purchase orders on account. So we'll make that $250 and $250. Borrowed $1,000 from the bank and signed a note payable for that account. So we're getting $1,000 cash from the bank. So let's go ahead and debit cash for $1,000, and we're going to get a note payable for the debit. So now we have an obligation to pay back, and that's $1,000. Bill the client $450 for services rendered. So I did something for a client, which I earned revenue. So that's going to be our revenue account is fees revenue, fee revenue. Should probably make that fees revenue. And so I'm going to make that D. And remember, I'm not billing a client here. I'm not getting cash. I'm sending a bill. So that should be accounts receivable debit. Accounts receivable debit and fees revenue. And that was for $450. Okay, so far, so good. On E, received and immediately paid the utility bill for the month, $270. So if I paid it right away, then it's just, it's an expense. I earned the expense, or I accrued the expense, I should say. So I'm going to go utility expense. And if I paid it right away, then of course I'm spending the cash by writing a check for it. So that's $270. Performed a service and immediately collected $200. Okay, so this time the service was rendered, but we got cash. All right, so we're gonna debit cash for $200, and it's just fees revenue for the difference. All right, so for the credit, sorry, $200 and $200. All right, moving right along. Paid for the office supplies purchase in transaction B. So we're going to pay. Ask yourself, first when you read these transactions, am I spending cash? And if you are, then cash has got to be your credit. So if I'm paying off office supplies that I purchased in transaction B, I have to get rid of the account payable because I no longer owe the money. So I'm going to debit the account payable for $250. Oh, sorry, it should be. And the account payable for that was $250, so $250. And then when I paid that back, I had to pay with cash. All right, so I'm going to credit cash for $250. All right, H received $150 from a client who had previously been billed. So I received $150 as I'm getting the cash. And they are decreasing the accounts receivable or the amount that they owed me. All right, so received $150. Whether this was the whole amount or some of the amount, that's how much we got. So we debit cash because we get cash, and we're going to credit accounts receivable because accounts receivable is going down by $150. All right, and then the next one, recorded but did not pay the telephone bill. So this is an accrual. We're not using cash here. So let's go ahead and record that under I. That was the telephone bill? So we have telephone expense, so we'll use telephone expense. So we accrued the expense. And we didn't pay it yet, so I'm just going to make, let's see, we have a accounts payable. So we're going to have to make an account called utilities payable. All right, so let's see. Let's just make it telephone payable. All right, so we'll have to make that account in there because it's not listed as a liability. So I'm just going to put the T account in there right away for telephone. Telephone payable. All right, and we'll use that later. Okay, so declared and paid a $300 dividend to stockholders. So now, remember on this one, we're just going to use retained earnings as the account that we're going to debit, because retained earnings typically is an equity account, so we can decrease its value by if we pay dividends. So I could go retained earnings. Debit that for 300. I'm sorry, I forgot to write the amount in there for the telephone bill, so it's 160. All right, and then so I got the retained earnings debit, and of course when we pay dividends, we'll just pay cash, 300. Okay. Received a $500 deposit from a client for work to be performed next month. So we're going to get some cash. This is K. We're going to get some cash, and we are going to, this is going to be unearned revenue. Didn't do it yet, so it's unearned. And that was for $500. Okay, so there's all the solutions to the journalization of the transactions. So you can go ahead and take a look at those. And I'm going to come back on the next video and I'm going to post these to the T accounts.